Many Nigerians have been struggling for months with rising living costs. Inflation is at its highest in 20 years, and the economy seems to be running out of breath, just as authorities scurry for solutions. But just a few weeks ago, the Central Bank of Nigeria, CBN, jerked up interest rates to 24.75%. But some experts say this effort might further hurt the real sector of the economy. In this story, Just Nigeria's Wale Fakile dives into what the CBN's new policies would mean for you and the economy.
Nigeria's economy thrives on constant movement, bustling markets, growing businesses and the endless flow of commerce. But beneath the surface, a delicate balancing act is underway. The Central Bank of Nigeria, CBN, guardian of the nation's economic health, recently made two significant decisions.
1. Raise the MPR by 200 basis points to 24.75. The NPC also enjoined the bank to expedite action on the recapitalization of banks.
These policies target two pressing concerns: the strength of Nigeria's banking sector and the fight against rising inflation.
The NPC,
the CBN's announcement, a banking recapitalization, and the hike in the monetary policy rate, MPR, have sent ripples through the financial landscape. The two policies are set to have far-reaching implications for average Nigerians, the economy, and businesses.
After reviewing the balance of risks and the near-term inflation outlook, members were convinced of the need to progress with the tightening cycle.
The interest rate dictates the cost of borrowing money in Nigeria. The CBN's decision to raise it to a significant 24.75% signifies the tightening of monetary policy. The goal? To curb inflation, the rising cost of everyday goods and services that squeezes household budgets.
So when they are taking up interest rates, the idea is one, there's better opportunity to invest because, for example, you can see bonds at 20%. So if you're investing a 10-year bond at 20%, that is a very good investment. What are they trying to do? Attract people to not leave money idle and invest it such that there's less cash chasing goods and to slow down inflation.
What does this all mean for you?
The cost of borrowing is high right now, and for those who have even borrowed before, some of them are receiving letters from banks because of the review in interest rates. So it's going to definitely have impact. And when I say impact, negative impact on them. SMEs that wants to borrow money, we also face the same challenge.
This could translate into slower economic growth, potential decrease in hiring, or even job losses.
It will affect investment in the MSME ecosystem, and also it will affect those startups who are trying to start new businesses among the MSMEs, and it will also affect expansion negatively in the MSME ecosystem.
Additionally, if businesses are forced to raise prices to cover their increased borrowing costs, consumer spending might take a hit, further dampening economic activity.
Government should have waited more for us to adjust to this high cost of energy and high cost of transportation, and also the naira that is farming up. At least give us some time, allow the naira to farm up, because some of us import our raw materials from overseas. So this is what we expect government to have allowed the system to stabilize a little bit, then before any increase in interest rate.
There are structural issues, there are long-term development issues that we need to resolve. But in the short term, just to stabilize the economy, just to take away that sense of panic, it is a step in the right direction.
I wouldn't say a rate should not be increased, but 600 basis points in 5 weeks is too much. The cost of the increase is more than the benefit of the increase.
This policy essentially tells Nigerian banks to hold on to a larger chunk of their own funds. CBN Governor Olayemi Kaduso says the sector had been stress-tested and it returned a clean bill of health. So, while this move strengthens the banking system and increases financial stability, it also presents some challenges.
The issue of capital raising is not an executive matter to be dealt with the MDs. It has to go to the board and it has to go to the AGM. And so it's the director's responsibility to raise capital, and we were not consulted. So banks that are doing minimal amount of business internationally should not require the same amount of capital to do international as banks that are doing a lot of business internationally. And I would have preferred a formula. If you're doing 10% of your business internationally, then you need 10% additional capital to 220. If you're doing 50% of your business internationally, then maybe you need 50% to 400, so you double, 50-50.
Capitalization is very, very important, because I cannot say that the banks were as strong as they were. Maybe some of the top 10 banks might be doing fairly okay, but most of the other banks, is important for them to recapitalize.
The last banking recapitalization in 2004 saw the reduction of banks from about 100 to 24. Under the new CBN directive, commercial banks with international licenses are to have 500 billion naira, equivalent to about $385 million, while those with national licenses are to hold on to 200 billion naira, equivalent to about $154 million. Banks with regional licenses are to have 50 billion naira, equivalent to $38 million. The banks have 24 months to meet the new requirements.
Asking banks to raise, it looks like about 4 trillion naira in the next 2 years in capital will be very, very difficult. Because given where the risk-free rate is around 30% today, you require 40%, maybe 35-40% return on capital to invest in banks. It's a little bit more risky than treasury bills.
When the central bank says that they've done a stress test and they think that the banks need to recapitalize, it means that if any wind will blow, we can find banks failing. And then there's usually that contagion effect where if one bank that we thought was good goes down, then everybody now starts wondering who is safe and who is not, and then it just affects every other bank. So if we need to do that, it's actually important for everyone to be sure that when they bring their cash and put it in the bank, they can go to bed knowing that everything is fine.
The CBN's decisions are a complex balancing act with potential consequences for various economic indicators. The primary objective of the MPR hike is to curb inflation. By making borrowing more expensive, the CBN aims to reduce the money supply in circulation, potentially leading to lower prices for goods and services.
The idea is that if we are taking up interest rates, then maybe we should be sorting out ease of doing business or balancing it out on another part, of unlocking a challenge or fixing a challenge in another area that would balance it out. But yes, when you take up interest rates, the general idea is that you're going to slow down the economy.
When you're combating inflation and you use so much of interest to combat inflation, it may discourage, it will discourage investment. When it discourages investment to bring down GDP. What is the implication of FX? We expect FX to further relax. Why? Because we're going to be seeing foreign investors who want to invest in portfolio, who wants to run portfolio investment in Nigeria. But will they come to the real sector? The answer is no, because we have not had institutional transformation as a nation.
So they have shrunk the banking space, both in terms of people that can afford to pay those interest rates and the amount of money available for deposit. So the banking business will shrink in the next couple of years. Into that shrinking business, you want people to bring in 4 trillion of capital. It's a bit of a contradiction.
The Nigerian economy is a vibrant tapestry woven with diverse threads. Businesses, consumers, entrepreneurs, and everyday citizens. The CBN's decisions have the potential to impact each of these threads.
But CBN says they're doing that because they want to support the Naira and they want to fight inflation. Laudable goals, but they come at a cost. The cost of doing those two things is that you're going to have your growth severely limited. You're going to have unemployment rise, you're going to have companies close, and you're also going to have more NPL. With this
capitalization of the banks, there are opportunities to invest. So if you already have cash, then you are possibly positioned to jump in on some good assets. But for the general populace, I would say this is one of those seasons when you just need to hang in there.
They need now to see how they can develop new products, think of other crowdfunding, alternative invoice financing, peer-to-peer, look at other sources of funding.
While the interest rate hike and capital-based requirements aim to address inflation and strengthen the banking sector, they also pose challenges for individuals, businesses, and smaller banks. Where the scale tips, will unravel as these policies are fully implemented in the next 2 years. Wale Fakilem, Gist Nigeria.
Interesting perspective. What do you think about the current interest rate in Nigeria? Share your thoughts with us on X at Gist Nigeria TV. We would like to hear from you.